war, interest rates, and a frozen housing market, not to mention AI mania. What's up, everybody? Welcome back to this week's episode of the Dynamis Podcast Market Update. I'm Tim Garul, joined as always by my co host, Bromley. And we got a bunch of stuff to get into this week. Oil remains elevated above $100 a barrel. Mortgage bonds are trying to stabilize after getting absolutely murdered this week. It's a bloodbath, Bromley, on the mortgage front. We can talk about that, and that's impacting the housing market. But this episode, this week, here's what we're getting into. We're going to break down why mortgage rates are remaining stubbornly high, the real condition of the housing market in 2026, why home prices have not crashed despite terrible affordability right now, and whether the AI boom is starting to resemble the dot-com bubble, Trump's China visit, and what it could mean geopolitically and economically, and where we think that money could flow if this market finally cracks. Bromley, welcome into the studio this week. I know you've had a long, busy weekend helping your mom out. It's pretty cool that as an entrepreneur, you have the time freedom to go take time and take long weekends and days at the bookend of the week and go help a family member in need if that arises. So pretty cool.
Thanks, man. Good to be here. And like you just mentioned, a lot of news over this weekend for sure.
Yeah. Let's start with before we get too much into kind of like the semantics of real estate and the stock market, things like that. I want to talk about China really quickly because this has been an interesting China visit. Number one, I don't remember the last US president that went to China. Did Biden go to China? Do you recall?
I don't recall. I believe that Trump's been or has had a number of meetings with President Xi, but I don't know about Biden. That's a good question.
Yeah, but I don't know. Were they on the home? So did they go physically to China? I mean, this has been a very contentious presidency between China and the United States. And there were some things that, I don't know, I felt went well on this last visit. I know that Trump ended up back at the personal residence of the Chinese leader, and typically Chinese don't put a lot of stock on friendships in politics or business. They're very pragmatic people. You typically see buttoned up, very tactical, strategic fronts, no emotion. But in this last visit, the shell was kind of cracked a little bit to where we saw the leader laughing audibly out loud in front of President Trump. So I don't know if that's a good sign or a bad sign that maybe they kind of got to the gooey center. Maybe that we can start to work on an agreement or at least have some sort of a relationship. But either way, one of the biggest geopolitical developments this week was the Trump's China visit, and the tone coming out of the meetings was surprisingly strategic rather than confrontational. I know we've been at ends for the last couple of years, at odds, I mean. But some key takeaways just to kind of talk about this high level really quickly is what they discussed was a continued discussion around trade normalization and supply chains, which is very important. Pressure on China regarding currency practices and manufacturing imbalances. They were doing some, quiet negotiating around energy and industrial cooperation, ongoing positioning against Iran and the broader Middle East instability. But what really matters to this market right now is that the world at large is kind of starting to split into what appears to be competing economic spheres, while simultaneously remaining financially interconnected. All right. We're having team A versus team B, but they're like codependent on each other at the same time. So what this creates is enormous uncertainty for things like oil, manufacturing, rare earth minerals, shipping, semiconductor supply chains, ultimately inflation. And as you know, and I know, Bromley, inflation is the enemy of the market right now. Long term, the trend appears to be, I guess, what we'd call de-globalization and strategic competition. But my question for you, Bromley, because it seems like the market has gotten really complacent with conflict. We saw like 9/11, markets went back to normal. Like, oh, it's just a war. Then we have like these ongoing skirmishes and the market prices them in temporarily, and then everything kind of goes back to normal. So, Bromley, my question for you, in your opinion, I want your opinion on this, is like, do you think that the market has gotten too complacent about geopolitical risk right now? It feels like investors just kind of become conditioned to assume that every escalation eventually just gets ignored and goes back to normal. So I'm curious to hear your thoughts on this.
I mean, I would actually go the other way. I think often investors are way too concerned with the news cycle and then making short term decisions, which just leads to trying to time the market. And if you really read almost any study of the probability of success when you're speculating on the market, it usually ends up poorly for you. So I would say, to the best that you can, to somewhat ignore the short term cycle and focus more on the fundamentals. Really, since that conflict started with Iran, the markets, the data, when you look at profitability forward guidance, has been relatively strong. And the big difference between the dot com bubble and sort of this AI revelation right now, revolution, however you want to put it, has been that there is extreme demand for these tokens, and the spend is off the charts, and the growth rates are off the charts. So it's being demonstrated in good finance, right? Good business fundamentals. But no, I do not think we should spend more time thinking about it. I think the bigger trend that you talked about is inflation, and if there's going to be something that could put out sort of this like gaslighting, right? This great energy, it would be inflation. And then a furthering of tighter monetary policy from the Fed to fight said inflation. So to me, that's the narrative I'm really tracking as I'm looking at things, not so much, okay, who we happy with and friendly with and who are we not. The other thing with this I would call it, this business leader and presidential joint contingency going to China that was interesting is that it was very much a business meeting. It was very much about opening up China for fair competition amongst some of the largest US companies. And I do think it's important for NVIDIA chips to be in China so that Chinese large language models are built on our hardware because of the same sort of like, Microsoft effect. Microsoft was a software company and sort of open sourced hardware, right? Whereas Apple was sort of its own built-in singular system. And I feel like for a long time there's so many businesses propped up on top of that. So I think that would be, generally good for the United States versus not allowing it at all, restricting trade and then being kind of, left out of that opportunity.
Yeah, I think I mean, that is a good point and good perspective. I'm curious, like, what's your thoughts on kind of seeing an emotional reaction from the Chinese leader? Very different than what we've seen in the past. You put any stock in that, or you think? I mean, are we? I don't know. What do you think?
Well, this meeting was supposed to have happened a number of weeks ago, and it was put off because of the conflict in Iran. So I think it was a pretty positive sign that one, we felt comfortable sending our president and top CEOs of like the Mag 7 as an example to China, that they weren't in harm's way. And I think it also the really, when you look at what was being said and what was between the lines, was much more of a collaborative message than the message that we're at war, there's a silent war and we need to de-risk, and all the kind of the tariff, almost like strong arming, seems to be putting aside, and it's a lot more about opening markets and free, a more free exchange of commerce.
Yeah, I mean, there. To your point, I agree. There conversely does seem to be a very evident and obvious aligning of power, right? Just kind of like the Allies and the Axis in World War II. We have these nations aligning themselves accordingly. Russia, China, Iran, for example. I am curious with this conflict in the Middle East how that impacted these discussions and negotiations, and then what that looks like moving forward. I know you and I talked about the poly market making a prediction that this conflict would be wrapped up in June, and I got to tell you, I really hope that that is, or not wrapped up, but at least some sort of agreement reached by June. I got to tell you, I really hope that's the case because it has been a bloodbath in the mortgage industry, and I guess that's a good segue to jump into that right now. So let's talk about mortgage bonds and why rates are stuck so high right now. So we've had a terrible few weeks. Friday ended terribly, Monday opened terribly. We got a little bit of recovery today, but overall volatility super high. And the big reason right now is oil, right? It all comes down to energy as it always does. So historically, when oil spikes this aggressively, what happens is that inflation expectations rise. So markets begin pricing in persistent inflation, long term bond yields move higher, and that crushes mortgage rates. But what's happening underneath all of this is that, and what I think a lot of people are missing, is that the Fed has been buying short term duration treasury bills from banks and roughly 40 billion per month from December through April to inject liquidity into the banking system after, what we as a country have agreed were continued financial stress concerns nationally. So that's very different from a traditional QE or quantitative easing strategy. During classic QE, what the Fed traditionally did is they bought longer duration treasuries and mortgage backed securities directly, which intentionally suppressed long term rates and subsequently helped mortgages. But this time, they're buying short term paper, injecting liquidity into banks, and then those banks are then lending the money back out into the system. So it's supportive for liquidity and the risk asset, but not necessarily supportive for mortgage rates. And now what's happening is the Fed is tapering those purchases towards 20 billion a month, roughly, give or take. And with Warsh, the new Fed president, there's growing speculation that these liquidity programs are eventually just going to disappear altogether. So I don't know. Do you think that the market is underestimating how dependent this rally has become on liquidity injections behind the scenes? And I guess if Warsh pulls back support, what do we think is going to break first? Do we think stocks, housing? I don't know. I mean,
I think usually stocks would break. Stocks are more liquid, so it can break much faster and then
yeah,
recover much faster. I would say real estate's got a much longer tail. So when things break, it takes a while. You get this like kind of like falling knife effect before
for
it
sure.
bottoms, and a long tail before it starts to rise again. The one thing about the market is it is, always trying to answer that question: Are things getting better or getting worse?
Yeah.
And it rip saws very quickly
I mean,
if
what's your
it's
personal perspective? Like 2 years from now, what do you think? Do you think we're booming or do you think we're in for a 2 year bumpy road? Stagnation?
I'm with you that I think if we can get out of this Iran conflict and get inflation back in check, that we're going to be ripping and booming. I think we're going to really see some of the most greatest wealth creation because the technology all backs it. But I'm with you. If there's one thing that could really throw us off, it would be we got to fight inflation. The Fed comes out and increases overnight lending rates. They stop any quantitative easing, so they pull back on liquidity, and then and maybe they go the other way, right? Like they're selling treasuries back into the market, which then means money's coming out of the market, right? So it's there's less monetary supply, and therefore, um, that could make lending very difficult. That could really crash real estate hard and put us in a bad spot. So to me, I think you're watching the right things, and it's not neither of our controls, but we want to understand, which plays today, if the worst happens, leaves us in a good spot. And then but also leave ourselves up for the opportunity of things going well.
Yeah. I mean, the question is always timing, right? Like when to strike, because if you're too early, it's disastrous. And if you hold too long, also disastrous. It's not really timing the market. That's not the point I'm making, but it's like taking calculated risk at opportune times. And I guess what I'm talking about specifically is, yeah, not timing the market, but being invested in the market so that you have every opportunity to ride the upwave and weather the storm. And specifically what I'm referencing is real estate. My next big venture, Bromley, is I'm gonna double down on real estate and I'm looking towards development as the next, frontier for me. And when I'm looking at the housing market right now, it's an interesting dynamic. You know, so I follow Calculated Risk. It's a great article. If you're not reading it, I would encourage you to read it. They have a free subscription. So Bill McBride, he writes for Calculated Risk. He wrote an article this week that really piqued my interest. And he talked about how the housing market isn't crashing, but it's totally stagnant. And he gave some data. I pulled some statistics from the article here, so I'll cite them really quickly. So sales in 2026 this year are basically unchanged from 2025 levels, which were already the lowest sales levels since 1995. So let's put this into perspective here, okay? We have a US population that's dramatically larger than they were in 1995, but transaction volume is sitting near the same levels as 95, all right? So what is the big focus here? Well, it's obviously inventory. So months of supply have now risen above pre-pandemic norms, which means that listings they're building, they're sitting on the market. Prices haven't moved meaningfully or collapsed because sellers are locked into super low interest rates, right? We went through this COVID interest rate era, and essentially they're just refusing to move unless they absolutely have to. So now we're in this position, and I'm just citing this article quickly as I'm going through it. So now rates have moved higher again because of geopolitical tensions and the oil shock. Mortgage applications were improving earlier this year when rates dipped, but now have completely softened. And this is like all pointing to the critical, indicator here that it's not just a rate problem, it's an affordability problem, a confidence problem, and increasingly a mobility problem. So we're in a really interesting position in the housing market. And to reference what I was talking about back at the beginning of like timing is like, I know housing's going to go again. I know it is. I know it is. The question is like, when is too early? And, as I'm putting feelers out for like, what's 2 years look like for now? Like builders historically have this margin where if you pay attention to new builds, permits, active construction sites, builders typically will not launch with a greater than 6-month inventory. If there's more than 6 months of inventory, what happens is builders completely shut down. You could go back and look at historicals on this. The reason is that they all got their butts spanked in 2008, right? We had all of this oversupply. Nobody could purchase. Builders sat and they bled out. All right. But what I also know, and when we reference Warren Buffett is like when everybody is fearful, that's when that's when psychologically we have to be greedy. So I'm sitting here, Bromley, in a really, really murky, muddy water, trying to get clear vision on knowing full well I'm going to launch. I know real estate is the asset class that's going to catapult me through that. Although I've been balancing more in stocks. We've talked about that on this show. And timing wise, not timing the market, but timing wise, it's like how do I make the best strategic decision on when to launch, when to hold, when to go, and to go at economies of scale. I know that housing is going to rebound. I know it is. I know it 100% certainty housing is going to rebound. So I don't know. I guess my question for you, Bromley, is like, at what point does a frozen housing market become economically dangerous to the greater market? Because right now it feels like this has just become a normal cycle, and more economic gridlock is what appears to be on the horizon. When does this have a greater impact on the economy at large? My personal opinion is like, I think this kind of just becomes a moot point and a non-issue over time as we stimulate GDP growth in the future. But I'm curious on what your thoughts are.
I mean, I would have to imagine the effects have already been felt, and yet the economy's been growing because, I mean, we're what, 4 years into a downturn in housing?
Oh yeah.
And that doesn't mean prices fell off a cliff, but 21 was the peak through
So this
2022.
year, national home prices are up 0.7% year over year. So from a composite 20 city index across the United States, 9% year over year.
Yeah, but realistically, that's losing value because
100% with
you add in
inflation.
3% inflation, we're actually negative. So
Yeah.
I think
Yeah.
you have to keep that into perspective. So realistically, I don't think housing's been keeping up with inflation for
Well,
about
and
4 years.
keep in mind, Case Shiller, where we're getting increase in like the cost increase data. That's a lagging indicator. So February is what's reporting, or I'm sorry, like the February report reflects contracts signed months earlier, some all the way back to October. So that's another thing that we need to consider is like we're looking at these metrics right now, but they're lagging indicator metrics.
They're lagging indicators, and it's not a homogeneous basket of goods either. Meaning,
Yeah.
the mix of price point that's selling can completely skew that number up or down,
mean, quite
right?
frankly, we're probably in a far weaker market than what most people want to admit about the housing market, truthfully.
I would agree with that. I would agree with that. I think we're in a very, very weak housing market. You can tell that because there's not a lot of transactions. From the mortgage industry has been hardened because there's not a lot of refi opportunities unless you really have to. And then depending on what segment or vertical of real estate, like commercial real estate, unless it's data centers, has been tough, right? Multifamily is tough, like very tough. And so I think the retail, like the single family 4 unit home, hasn't really seen the brunt of it, except for in some markets.
Yeah,
But, Austin had a year where it was down 26%. I think a
that's
lot of
insane.
markets in Florida have been dropping and they're still dropping. So are those is that the leading edge? And you think about it like you're on a roller coaster, right? If you're in the front seat, you feel that drop first, and then there's a whip before that last seat goes.
Yeah,
So I
that's a
don't
good
know if
point.
we're kind of rounding that top and we're all about to fall, or if it's going to be more of a, hey, it's flat from a price perspective because these buyers don't have to sell and there's a psychological level that'll let them. But with inflation priced in dollars, the value of the home is going down. But
Yeah,
I think the other big trend we have to watch is what is this transition from the baby boomers to Gen X and millennials? What does that look like? Because I'm seeing it every day. There are a lot of people that did not have money that all of a sudden have 1 million, 2 million, 5 million, and they didn't build it. They just inherited it. And their spend habits, right? Like they're now all of a sudden they can buy the home. Now all of a sudden they can furnish it. Now they can get the nice car they never had. So I do think with the trillions of dollars locked up in real estate, when this current generation, baby boomers pass it to the next generation, I don't think it's going to be trapped equity. I think it's going to circulate through our economy. And that's another thing that's kind of got me bullish that there's going to be a lot of spending. Now, is that good long term? Who knows? But I think certainly in that kind of midterm, you're gonna see a
I think it's
lot
going to
of
be a slow
lot of
titration, though.
spend.
Everyone talks about this like silver tsunami of like all these baby boomers, but the baby boomer generation is big and expansive. I was thinking about this the other day. It's like, okay, for example, like I don't need inheritance from my parents. You and I have built our own portfolios. But let's just say that I did need it. Okay, well, let's assume. All right. I know some people with baby boomer parents and they're, about to pass on. Okay. And then they're about to receive an inheritance. Luckily, my parents, they're healthy and fit. And I guarantee you, like, there wouldn't be an inheritance event for, I mean, a high likelihood of 20, 25 years, right? So I think it's going to be like slow titration. I bring that up because, I'm almost 40. So okay, let's say that I receive an inheritance at 60 by that point, okay? But at the same time, we have people receiving this inheritance like you're seeing today. I think, all of this hype about this silver tsunami inheritance passed down of generational wealth, the biggest transfer, it's going to be slowly titrated over time to where the economy is going to absorb it. It's going to be like a normal, I don't think it's going to be like this wave of like this, benchmark of like, whoa, here's all this wealth transfer. It unlocked the economy and now people are spending and their spending habits are different. And I don't know. I think it's going to be a slow titration where it's going to be like less of a big deal. And the market's so weird right now. It's just so weird because unlike 2008, for example, where we had this like stale housing market, buyers aren't distressed. They have plenty of equity. They don't have to sell. They have fixed rate mortgages that are 2%. So it's a very odd. We're just in a, I don't think we've never been in a situation like this before,
Well, 2008 was so different. So from my own personal experience, and I was, pretty eyes wide open. I didn't own a home in '08. I had graduated, but I was watching it very closely and I felt like, hey, this time matters. I need to pay attention because at some point, like what I learn watching this will be important, right? Like I don't
Right.
know why, but I had that feeling during that time. And a couple things, like you just mentioned, there were significantly more negative amortized loans or upside down, right, debt, right? So you don't have that. Now there's pretty healthy down payments and more equity than at any point in ever. The variable rate mortgages was huge. I remember people saying that the introductory rate had eclipsed. And now with interest rates climbing because they were going up at that time, all of a sudden their payment tripled. So you've got a condo in, California somewhere, and then your payment triples. Now you can't afford it. Plus, you basically can't exit because there's no equity, there's no buyers,
And
and now
that's
you're
exactly
turning
what
it
they
over.
told people is like, well, if you get into trouble, just sell it, you know? It's like, well,
Well, and for a while, that felt like the right, real estate always goes up. So if you buy it today, even with no money down, and you're in it for 2 years, then you could sell it for more. And that was true until it wasn't. Right. But I think that was really the crux of it is that all of that. Plus, I think we tested close to 10% unemployment during the middle of the pandemic. So a lot of people just didn't have incomes, couldn't afford their mortgages. So all three of those factors contributed. Right now, I think we're at what, four and a quarter unemployment, relatively low, even though AI has taken over all our jobs. I hope I don't regret that statement, knock on wood. But I think the other thing is, like, I remember distinctly flying to Arizona. I forget where I was going, and Zillow or Redfin were like brand new apps at the time. And I remember looking, and it was like every home in a neighborhood was up for sale, like every home. So it was like the amount of inventory was off the charts,
right,
and we're
right.
just not in that. It's very
We're
hard to
not,
find. Yeah, I'd
but
even
we
want to.
are ticking up. I mean, inventory is increasing. I don't it will never get to that level, never say never, but it isn't we are seeing higher and higher amounts of inventory on the market, and it is something to pay attention to.
Or just
So,
walk down your street, right? Like you've got a cul-de-sac. So back then it would be like two of the homes in your neighborhood were not for sale. Everything else was for
right.
sale.
Now 2 are for sale. Yeah.
Now two are for sale. Exactly.
Yeah. Yeah. No, for sure. You're absolutely right. We're not in 2008, but we are in a unique time that requires discipline and attention for sure. There's no doubt about it. And I mean, I myself have bought properties over the last 4 years, 5 years that I have to hold on to right now. I couldn't sell. I bought a mixed use commercial property, and because of cap rates, and I'm at the top of market rent on this commercial property. But when you do the math on the cap rate, I would have to sell right now for $150,000 loss. I can't get out of that. I have to ride it out. I just have to. The only way out is through right now. So,
Yes.
anyways, we're in an interesting time now. Fortunately, the market at large isn't like that, and most residential buyers aren't forced to move. But yeah, it is interesting. I mean, we've been in this cycle where I remember, like, what was it? Survive till 25, and then it's like
No,
what every year it was like something else, right? I was like, I can't remember what 23 and then 24 and then 25, and now we're in 26, saying hold on till 27, and then so I don't know, man. This has been a really long drawn out, and people always talk about, oh, this is nothing compared to 2008 and blah blah blah, but it is not a small thing. I mean, we definitely are in a precarious market that I think some of the older generations take, slightly for granted, or I think they dismiss maybe a little more quickly than they should. So, but conversely, stocks are ripping, right?
yeah. I mean, they're down a little bit today. I know the Jones Industrial had gotten back to 50,000, and I think closed today around 49. But for the most part, if it's not the top of the market, it's near all time
I mean, how
top. And
concerned are
like I said,
you that the growth is so concentrated? I think I was reading a stat that like Nvidia alone is representing like almost 8% of the S&P 500. I mean, that's
yeah, it's
crazy,
like
right? That's pretty
five
concentrated.
and a half trillion dollar company, and then
Yeah.
we've got the IPO coming up for SpaceX, which is going to test nearly $2 trillion.
Whoa. You buying SpaceX?
There's
I am. Let's go, dude.
Oh yeah, I'm loading up on Tesla, and I'll definitely get some SpaceX as well.
Yeah, me too, dude. I've been waiting for SpaceX to go public for years. I'm like, oh man, when that goes public, I'm buying.
Yeah, it's
That's not a company that's going away.
Yeah, I don't think so. They're way too innovative and they're vertically integrated in a very nice way. I think they've
Well, we
sort of
talked about this. Remember, you and I were placing bets, and we're like, "Who do you think is the winner?" And I was like, "Dude, I got to tell you, I think it's the company that's completely vertically integrated. They make the chips, they have the rockets to launch into space, they provide the internet, they have cars that are autonomous and driving around, manufacturing facilities. I mean, this was like, I don't know how
they
long
got
ago,
the
2 years
robots.
ago,
Yeah.
when I was like, dude, I'm all in. I think if I had to push all my chips in on one company, it's a company that can completely vertically integrate, you know? And then you have to sit back and ask, like, did he really plan this like this, or was this opportunistic? You know, was he the mad scientist, like secretly designing this master plan, you know, just in order, like, okay, I'm gonna do this and this and this, and no one's gonna know what I'm doing, and then all of a sudden, boom, it's all connected and vertically integrated. Or is it opportunistic?
It's like it sort of seems like it has been. Like, how do you get that lucky?
Yeah, I think this was a well thought out plan that he executed slowly and I mean, yeah, secrecy almost, you know?
I mean, I think even if you just look at Tesla, right? Like initially, it's like, hey, we've got to make it so cool that people will put a deposit down, so we can
Yeah,
fund R&D, so we can actually produce that product,
products that
and then
never
we're gonna
even came, honestly.
price it super expensive, and then slowly like take over market share by introducing lower end models along the way. And yeah, that worked. And then behind that was an AI company, and behind that was an energy company. And what's the best sector to be in? May 18th, 2026, energy.
Energy.
Not just because of the spikes in oil, but also because of the spend that this or the amount of energy to power these data centers. So, I think he's also in telecommunications and satellites and space. And, it's incredible. And then not to mention some of the things that are coming, Boring Company, and
But yeah.
not even sure what the human cyborg, chips are, but like that's got some real capabilities.
Yeah, it's pretty interesting to see what he's got on the horizon. I mean, I'm sure there's things that we can't even fathom yet, you know? And it's all, what's funny is like, it was all under this guise of like, we're going to Mars. But I wonder, is it, you know?
Yeah, I mean, he's like a visionary. He's like, this will get everybody's attention.
Right.
It'll recruit investors, and maybe it
And then
was
I
just to
point it.
become the world's wealthiest human, but certainly worked. But the other thing is like Grok, I don't think is the favorite language model by any means, but he decided to build the biggest data center, right, with the most Nvidia chips, and now he's leasing that space to Anthropic, who is compute constrained but has all the demand.
Right.
And so now he's basically Amazon, what's it called, cloud, right? Or
Right.
AWS, Amazon Web Services,
Yeah.
but it's like Grok, XAI.
I think don't sleep on Grok. And here's why. Because dude, this guy is smart. Okay. What he's working on behind the scenes. So, talking about being vertically integrated, dude, he's integrated Grok into everything. When you get Starlink, you need customer support. Guess who answers it? Grok. When you are on Twitter and you want to fact check something, guess who's fact checking? Grok. Every one of his companies, Tesla, I'm sure SpaceX, all of them have integrated his AI, his LLM into it. And so I think what we're seeing right now is going to be dwarfed by what eventually comes in the future. I think that we're not seeing the full hand. I think he's showing us only what he wants to show us right now. I think there's something much bigger coming in the future, and it's all going to be woven together. So, anyways, I know you got to get out of here, Bromley. You got 3 minutes on a hard stop. So let's exit with what we're watching this coming week. Tuesday, we got ADP employment data coming out and pending home sales. Wednesday, we got mortgage applications data, 20-year treasury auction, and the Fed minutes is coming Wednesday. Thursday, we got housing starts and building permits. I'm going to keep my eye on that. So, anyways, I guess in closing, I mean, what we covered here today, housing's frozen, stocks are euphoric, oil's elevated, rates remain harsh and restrictive. Geopolitics are driving markets almost as much as economic fundamentals. There's still money to be made, guys. There is absolutely opportunity and money. But this is not a market to just go blindly chase opportunities. By the way, I don't know if you heard, but did you know that on one of Brandon Turner's Houston deals, the B class investors lost 100% of their investment? 100% of their investment from Brandon
I
Turner's
mean,
Core Capital.
I didn't know that definitively, but I've been hearing there was enough smoke around Brandon Turner deals. My understanding is that, I mean, he talk about a hyperscaler at the wrong time. Like, he raised a ton of money
Yeah.
right at the top of the market. And, not only did the cap rates decompress, right? They went the wrong way on him, but the business plan, my understanding is, wasn't withheld. And then the debt servicely isn't being serviced, or at least within its covenants. So
Yeah.
not
Guys,
surprised.
this is a market that demands discipline, demands discipline. There's no free money, there's no easy button. Okay. You have to understand who these operators are if you're investing your money with someone. So invest wisely with people that are prudent, patient, have been through market cycles, people like Bromley. Okay. So, anyways, at the bottom of the show notes here, you guys check it out. If you want a free consultation with Bromley, he's happy to come look at what you're doing, what your portfolios, what your fees are. If you could maybe move some stuff around to get a better rate of return, maybe protect some cash in this volatile market. So I'll at least be with somebody who's disciplined in executing a plan. You guys want me to take a look at any of your housing needs, mortgage, refinance, anything like that? Interested in you know, throwing some capital into any of our ground up development projects, scroll down below. All of our information's in the show notes. With that being said, thanks for listening on your march to multi-millions and beyond. Stay frosty. Catch you on the flip side. Bromley, see you next week, my man.
See you all next week.
Peace.
All right.